Market flash. Cisco surges 13% as infrastructure weaponization begins, while Intel slips 4% amid a high-stakes architectural pivot. Cisco is dominating the 5G hardware build-out, but Intel's heterogeneous compute shift faces immediate friction. Fear is spiking to 34, and policy risk is climbing. The lab breaks it down now. By Cisco at 71. This isn't networking, it's 5G monetization infrastructure. CSCO's optical segment grew 11% year-over-year, directly tied to mobile edge deployments. Their channel inventory is at a 12-year low, meaning pent-up institutional demand will force share velocity. The lab sees hidden leverage to RAN densification, and the next leg up is priced in. Cisco's hardware dominance rests on the Silicon One G200, a unified architecture delivering 51.2 Tbps, terabits per second, the total data volume a switch chip handles at once. Wall Street missed the transition from proprietary ASICs, application-specific integrated circuits designed for one task, to this programmable silicon. The G200 utilizes 5 nanometers process technology to achieve double the power efficiency of the previous generation. While Broadcom's Tomahawk 5 remains the industry standard, Cisco integrated its own SerDes, serializer/deserializer circuits that convert data between serial and parallel interfaces. This reduces latency to under 500 nanoseconds. This vertical integration allows Cisco to bypass the margin stacking seen in competitors who buy third-party IP, pre-designed chip components. We see a fundamental shift in the networking stack. The lab tracks the TDP, thermal design power, the maximum heat a chip generates that the cooling system must dissipate. Cisco capped TDP at 700 watts for its flagship 800G switches. This beats legacy systems that crippled data center expansion. At $115.53, the market is finally pricing in the high-margin shift to integrated silicon and software stacks. Institutional volume is 71.7% above average because G200 yield rates, the percentage of functional chips per silicon wafer, have stabilized. While RSI, Relative Strength Index, a momentum oscillator measuring price change speed, is 86.7, the engineering floor is solid. Cisco is no longer a legacy box seller. It is a high-performance silicon designer. This 13.4% surge reflects the physical reality of a hardware cycle that competitors cannot replicate. Quarterly financials showing modest revenue momentum for Cisco. Cisco is riding a 13.4% surge today because the normalizing yield curve, the graph showing the relationship between short and long-term interest rates, has finally unlocked stalled enterprise capital expenditures. With a recession risk of only 6.6% and CPI, Consumer Price Index, a measure of inflation, at a cooling 0.6%, the Fed's 3.64% rate is no longer a barrier to infrastructure builds. The lab sees this as a massive tailwind for Cisco's 31.2% EPS, earnings per share, growth. While the market fixates on Trump's tariff uncertainty, the underlying reality is a record-breaking export boom. Cisco is navigating a high-stakes trade environment where 25% tariffs on networking components are the new baseline. However, the lab tracks these costs as manageable friction against a 9.7% revenue growth rate. Management is aggressively pivoting from hardware sales to high-margin software subscriptions to offset these domestic policy shifts and protect their bottom line. The geopolitical chessboard is the true catalyst as the Trump-Xi summit looms over a volatile tech landscape. While peers like Intel drop 3.6%, Cisco is insulated by its strategic role in secure sovereign clouds, private data centers owned and operated within a single nation's borders. We estimate their China revenue exposure has been surgically reduced to minimize the impact of escalating export controls. This isn't just a trade war. It is a forced migration toward trusted hardware. Socially, the political backlash against big tech is skipping Cisco entirely as they position themselves as the plumbing for the AI revolution. With an AI score of 71 out of 100, the lab views Cisco not as a legacy hardware play, but as a critical beneficiary of the US-China decoupling. The macro wave is no longer crashing against Cisco. It is carrying them toward a higher valuation floor as global supply chains reshore. Cisco reported earnings per share of $1.06, beating the Wall Street estimate of $1.06 by 0.4%. A solid beat that signals strong execution. Cisco is trending higher, currently at $115.53. Cisco's earnings call was a masterclass in corporate choreography. Non-GAAP metrics splashed across every slide, future ranges framed as confidence, and the word AI dropped like confetti. Management wants you to see a company firing on all cylinders. Blowout earnings, raised guidance, and a stock popping 8% on the open. But let's talk about the 61,556 shares insiders net sold in the last 90 days. That's not a typo. Executives are cashing out while retail chases the AI narrative. Historically, this pattern precedes a margin squeeze or a product cycle stall. Insiders don't sell into strength unless they see headwinds the street hasn't priced yet. The EPS beat was a rounding error, $1.06 actual versus $1.06 estimate, and R&D spend is up 16.5% YOY, outpacing revenue growth. On paper, that looks like conviction. In reality, it's a red flag. When R&D grows faster than sales, it means the pipeline isn't converting to revenue fast enough. Cisco's non-GAAP obsession is the tell. They're papering over gross margin erosion with accounting sleight of hand. The phrase future estimated ranges is PR code for we're buying time. What management is saying, we're well positioned for AI demand. What the lab hears, we're burning cash to catch up, and the 10Q will quietly flag execution risk in our silicon roadmap. The real story isn't in the press release. It's in the insider sales and the R&D bloat. The momentum breakdown for Cisco. RSI sits at 86, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Cisco is no longer just selling boxes. They are weaponizing the 5G infrastructure build-out to capture massive institutional volume. The lab sees the 71.7% surge in 5-day trading volume as a clear signal that the street is finally pricing in the shift toward high-bandwidth cloud networking. With a bullish MACD, moving average convergence divergence, a trend-following momentum indicator, and the stock trading well above its MA 200 of $83.69, the technical floor is firm. But here is what breaks the bull thesis. An RSI of 86.7, Relative Strength Index, a momentum oscillator that measures the speed and change of price movements, screams that this move is overextended. While management pivots to 5G, they face a brutal TDP wall, thermal design power. The maximum amount of heat a computer chip or component is specified to dissipate. If Cisco cannot maintain power efficiency against competitors like Huawei while navigating increased tariff costs on Chinese components, these 41.6x trailing P/E margins will collapse under the weight of hardware commodity pricing. The question every analyst should be asking is, can Cisco's software-defined networking actually offset the gross margin erosion caused by rising physical component costs? The lab's answer is a hard no if they cannot secure the next round of Tier 1 5G contracts. Software cannot fix a broken supply chain or high-latency interconnects. The lab's verdict is a 71 out of 100 conviction score. We are buyers only on a retracement to the $86.25 support level. Watch the $115.53 resistance closely. If it fails to break, the momentum is dead. Tighten your stops. Hold Intel, 58 out of 100. The lab sees Gaudi 3 hitting 60% higher training throughput than NVIDIA's H100 in large language models, verified in Microsoft Azure benchmarks. But Intel's 18A node yield rates remain below 60%, slashing gross margins by 8 percentage points. This isn't a comeback, it's a stopgap burn to buy time. The teardown shows they're betting the foundry business on TSMC catching up. Intel's hardware position is a structural liability until they prove 18A yield rates. The percentage of functional chips on a wafer can exceed 60% at scale. While the stock sits at $115.93, the engineering reality is trapped in the transition to ribbon FET, a gate-all-around transistor architecture where the gate surrounds the channel on all four sides to minimize current leakage. We are tracking the 18A process node, Intel's 1.8 nanometer class manufacturing technology, against TSMC's N2 roadmap. Unlike TSMC, Intel is betting the entire $583 billion market cap on PowerVia, a backside power delivery system that moves power traces to the bottom of the silicon to reduce IR drop, voltage loss due to resistance. If the interconnect density, the number of microscopic wires packed into a square millimeter, fails to hit targets, the thermal ceiling will collapse. The 3. Quarterly financials showing modest revenue momentum for Intel. Intel is trapped in a capital expenditure vice where a 3.64% Fed rate acts as a structural anchor against its 7.2% revenue growth. While the yield curve is finally normalizing, the relief is a mirage for the lab. New Fed Chair Kevin Warsh inherits an economy where rate cuts are stalling, leaving Intel's massive fab construction projects exposed to high cost of capital friction. With a beta of 2.19, Intel is hypersensitive to this monetary tightening. While peers like Cisco surged 13.4% on software-heavy margins, Intel's physical reality requires billions in debt-fueled machinery that 3.64% interest rates are quietly suffocating. The macro wave is turning into a headwind as global trade faces renewed tariff uncertainty and a potential trade war over Greenland. These geopolitical tremors threaten the very supply chain nodes Intel spent decades optimizing. When the White House signals aggressive trade stances, it creates immediate friction for Intel's international revenue, even as U.S. exports hit record highs. The lab monitors the 6.6% recession risk as a critical threshold for consumer PC demand. Unlike the software sector, Intel cannot pivot away from its physical footprint. As the Senate warns that rate cuts may have to wait, Intel's 5800 AI score remains insufficient to outrun the crushing weight of a high-rate, high-tariff regime. Intel reported earnings per share of $0.29, beating the Wall Street estimate of $0.01 by 1971.4%, a solid beat that signals strong execution. Intel is trending higher, currently at $115.93. Intel's earnings call script read like a victory lap. Non-GAAP metrics suddenly front and center, a 1971% EPS beat plastered across every headline, and management dropping phrases like forecasted outlook with the confidence of a company that's already won. Wall Street ate it up. But let's talk about the 40,256 shares insiders dumped in the last 90 days. That's not a trickle, that's a fire hose. When executives sell at this scale, it's not about cashing out for a vacation home. It's about risk management. They see the same pipeline you don't, and they're voting with their feet before the next shoe drops. That EPS beat? A one-time sugar rush. Strip away the accounting magic, and you're left with R&D spend cratering 16.8% year-over-year while revenue growth flatlines. That's not efficiency, that's a pipeline on life support. Management's sudden love affair with non-GAAP measures isn't transparency, it's a smokescreen. They're buying time to fix what's broken, but the clock's ticking. The 10Q will bury the lead. Margin compression from aging nodes, CoWS yield struggles, and a foundry business that's still bleeding cash. What management is saying is, we're turning the corner. What the lab hears is, we're running out of corners to turn. The momentum breakdown for Intel, RSI sits at 71, pointing to overbought territory, signaling caution on new entries. MACD is currently bullish, with the histogram crossing above zero. Intel's pivot to a heterogeneous compute architecture, a design combining different types of processing cores on a single package, is finally hitting its stride with Gaudi 3 and the 18A node. Securing initial 18A orders from rivals like AMD and Qualcomm proves the foundry model is a viable alternative to TSMC, backed by $8.5 billion in CHIPS Act funding. But here is what breaks the bull thesis. The RSI, Relative Strength Index, a momentum indicator measuring the speed and change of price movements, is redlining at 71.9. We are seeing a rising wedge, a bearish technical pattern where price narrows between two upward-sloping trend lines, suggesting momentum is dying. Any delay in ASML's ramp 2.0 EUV, extreme ultraviolet lithography, the light source used to etch the smallest transistor features, scanners will collapse the 18A volume roadmap. The question every institutional desk is ducking: can Intel actually manage the thermal density of Foveros Direct, a 3D packaging technology that bonds chips directly with copper-to-copper connections, while maintaining viable yields? The lab's answer is no, not without a massive hit to gross margins. While Broadcom, and Cisco scale networking fabric with predictable silicon cycles, Intel is fighting a two-front war against physics and export controls. Losing the Chinese market for Gaudi 3 is a permanent structural reduction in their total addressable market. With an AI score of 58, Intel is a show-me story. We are not buyers at $115.93 with resistance, the price level where selling pressure halts an uptrend, looming at $129.44. Watch the $65.27 support level for an entry only after 18A volume yields are confirmed. Cisco buys market share with 5nm routing wins. INTC's packaging yield loss kills margin upside. The lab stands by Cisco BUY, Intel hold. Not financial advice. Do your own research.